What's up everyone, it's Kadi with MoneyVest. So in this video, wanted to share my views on the markets and of course how significant the rally was yesterday, even after the hot CPI report that we got. But on the day today, of course, we do have the markets somewhat rolling over, slightly down. The NASDAQ's about 0.5%. The S&P here also down about 10 basis points, so more or less flat here. But of course, a lot of individual stocks, including the Magnificent Seven, they are selling off on the back of AMD, NVIDIA, and more specifically Tesla and Apple and Meta here selling off. We did have a majority of lawmakers kind of voting in favor of the US TikTok ban and also kind of forcing the company to divest its operations in the US. But of course, we did have over 61 votes in favor against of this kind of law moving forward with this, right? So again, majority of the votes coming from the Democratic Party and Republicans. I think over 16 people voted against this law here. But that's going to be for a separate video where we discuss Meta and its future, because it's kind of competing directly on the social media side against TikTok and ByteDance. But in this video, I really want to talk a little bit about what Tom Lee tweeted just about yesterday, talking about the market's rally on the back of this hot inflation numbers, and really discuss the greater fool's theory and go over some very important metrics to also keep in mind. As always, make sure that you drop a like if you enjoyed this video, and of course subscribe to the channel if you haven't already. I would really appreciate that. A link to our Discord and Patreon is going to be down below. There is a 16% annual discount that's available until the end of this month, and this right here is the tweet from Tom Lee talking about, today, quote unquote, hot CPI equals not good, but stocks rally because of, quote, gas left in the tank because bad news is priced in or investors are underweight equities. So I really want to touch on the reasoning, right? Because I mentioned this in my yesterday's live stream. I said that, I'm not going to trust this rally because even after a very hot CPI, which Tom Lee also agrees is not good for the market, and the stocks yet still rallied, right? So that was a little bit confusing, and I mentioned this in the live stream that, look, I could see a rug pull in the market considering how much optimism there was even after the hot CPI. It's possible that we do see some profit taking. However, we did see the markets continue to rip higher because of what Tom Lee believes to be gas left in the tank, because a lot of bad news is priced in or investors are underweight equities, because there's a lot of money market funds still sitting with trillions of dollars in cash. There's a lot of capital still sitting on the sidelines. And again, he says that today rally evidence of tons of dry powder, again, aka gas left in the tank or money sitting on the sidelines. So I really want to kind of touch on who do you think is the type of buyer in this market? Like who do we know? Who do you really think or believe is the type of buyer or type of investor who's deploying cash in this market where we are at an all-time high? We're extremely overbought technically, and fundamentally we're trading at the upper range of our earnings multiples and the earnings yields that are sitting at well over 4.5%, close to 5%. When you look at the 10-year treasuries and just the bond market in general, anyone with a brain would understand that the 10-year treasuries and the bond market is attractively priced on a risk-adjusted basis. Again, I want to emphasize on this point, on a risk-adjusted basis compared to the market in general, and of course a lot of individual stocks. And this is the type of market, as I said before, is what kind of sucks in a lot of liquidity, because you see all stocks going higher. You see, markets in just this rally mode where there's no signs of pulling back. There's no catalyst that can drag us lower, and we just keep pushing higher and higher and higher. And this is the type of market that very, very desperately sucks in a lot of liquidity and more specifically desperate buyers that want to make a quick buck. And that, of course, never ends well, in my opinion. So this is the forward price to earnings multiple on the on of course the entire market, and more specifically on big tech stocks. Now, I'm not here to say that a lot of these companies, let's say, are overvalued or expensive or anything, but they're by no means. Let me rephrase the question. So if I ask you, is Amazon, Apple, Microsoft, NVIDIA, AMD, Google, Meta, Apple, like all these companies, Costco, for example, Eli Lilly, if I ask you, like, are they overvalued? Or Tesla, if I ask you, like, are they overvalued, or are they, trading at an expensive valuation? We can go, have a debate about this. We can go back and forth, and there'll be points that you put forth that, oh, Caddy, NVIDIA's growth is fantastic with AI, Amazon, blah, 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 Apple is doing all these things. We can go back and forth, right? If you put 10 investors in a room and ask that question, is the market overvalued? Is Microsoft, NVIDIA, Amazon, Apple, are they trading at overvalued levels, or are they expensive? We can go back and forth kind of justifying that no, they're not, or yes, they are. But let me rephrase the question. Are they undervalued? So that's the new question. Are they by any means undervalued, right? That's the question that I'm trying to ask now. So is Microsoft, NVIDIA, Amazon, Tesla, Apple, Costco, Eli Lilly, are they cheap? Are they undervalued? Are they inexpensive? Different question, but we'll bring up to the same point. And in that question, I think we'll have a less of a discussion than in the first question, because first question, we're trying to justify why the stock is not overvalued, because we may own it or we may be very optimistic on it. But in the second question, we're trying to justify why the stock is undervalued, right? So that would be much more difficult to justify, because we all understand that, okay, 32 times earnings, 41 times for Tesla, 30 times for NVIDIA. And I've not even brought up the price of sales. If you go over to the price of sales, we're looking at 36 times sales for NVIDIA. Microsoft's at over 13 times. Eli Lilly at over 21 times sales. 21 times sales, folks. We got Meta at over 9. We got Google at over 5.7. Apple at just under 7. I would still argue that those are pretty reasonable, but by no means that these are undervalued. These are cheap, right? So and again, I've mentioned this before on the channel, is that I would only want to buy something when it's cheap, when it's inexpensive, when it's actually undervalued. Because if I were to able to represent and display what it actually means, is that there's a fair value line. Right? There's a fair value meaning the intrinsic value, and that's how much an asset is actually worth at that point in time. That's the fair value line. Anything that's above the fair value line is overvalued. Anything that's below the fair value line is undervalued, and I want to capitalize on anything that's below the fair value line. So us discussing that, okay, the stock market's not overvalued, is not the same as us discussing the stock market is undervalued. Because the stock market may very well could not be overvalued. It could very well be borderline fairly valued or somewhat overvalued, but it is by no means, at least not in my opinion, undervalued that I can start deploying significant amount of cash in this market. I think the right approach here in this market, of course, is to sit back and hold. I think holding is a much better strategy in this market, and kind of sometimes doing nothing, it ends up being the best trade that you can actually take. Instead of doing too much, you can actually end up doing nothing, and you'll be better off, because then you're making fewer decisions, higher quality decisions, and trust me, your gains and your profits will reflect in your portfolio. Now, this right here is another thing that I want to discuss, is the greater fool theory, right? It simply states that there will always be a quote-unquote greater fool in the market who will be ready to pay a price based on higher valuation for an already overvalued security. And again, this right here is how to avoid being a greater fool. And as I said, if you put 10 investors in a room and talk about, okay, are these stocks overvalued? There will be people who justify that they're not. And they may be right long term. They may think that, okay, there's a lot of technological innovation happening. There's a lot of momentum. There's a lot of potential for these companies, for these stocks here. But of course, at the same time, how high of a valuation are we willing to pay? Right? Just depends on investor to investor, right? Depends on analyst to analyst. So really the bottom line here, and this is going to be the relative volume over the last 6 months. And what you'll notice is that NVIDIA is trading at over 2.5 times its relative volume, meaning that 2.5 times its average volume is what NVIDIA is kind of trading on in the last 6 months. So definitely getting a lot of attention. Oracle also at over 2 times. We got McDonald's at over 2 times. Amazon is actually trading at less of its average daily volume. So is Apple. So is Meta, surprisingly. And we got Google here just over 1, and Microsoft at a little bit over 1 as well. So if you come take a look at the markets, right now as we stand, we got the NASDAQ here, consolidating sideways, 62 basis points. We're at a resistance, and we're seeing a lot of stabilization in the market, consolidation in the market, and same thing with the S&P 500. We're seeing some sideways action on a week-over-week basis also. This week, we are up over 81 basis points on the back of the inflation rally from yesterday. And I did mention this in the newsletter as well, that look, there's potential. There's a possibility that we keep kind of drifting slowly and steadily higher, but the upside potential here does not outweigh the potential downside in the market. And for that reason, I think it's really important for myself. I'm giving myself that recommendation to hold right now, sell calls, and keep hedging and generate that cash flow. And at the same time, have about 18-20% cash at the moment, which is what I have, to wait for the right opportunities, wait for better opportunities as we continue to see some individual stocks sell off. For example, Tesla here dropping pretty aggressively in the 150s would make for a good sort of fair value at those prices. Google in the low 120s, as we've already discussed. Apple in the 160s, down in the 150s would make for even better opportunities, better trade ideas. And then of course, NVIDIA, AMD, I don't even want to start how much lower they would need to come down before I can even consider them from an individual basis. And then finally, Microsoft also in the low 360s and 300s, 350s basically is where I would consider it. And Meta here also selling off, but it's got different catalyst also on the day with the lawmakers voting on this TikTok bill. So again, support level is going to stay at 386. So the bottom line and the only lesson that I want you to take away from this video is that don't get sucked into this rally just because everybody else is buying. Because oftentimes, I mean, if you're buying at an all-time high, there's no harm if you're buying the aggregate index. I just want to be very clear. If you're buying the aggregate index, if you're buying the S&P 500 for the long term, you've got a 20 plus time horizon, simply want a dollar cost average every single week, every single month. Totally fine with that. Keep doing that. That's what I'm also doing. But when it comes to individual stocks trading at all-time highs, and there's people making justification for why it's still a good buy, because I've seen NVIDIA's price target go up from like 800 to 1,000 to now it's sitting well over $1,200 because analysts keep following the price target. Analysts keep following the price action. If it keeps going higher, all of a sudden the earnings are growing. All of a sudden the price targets go from 1,000, 1,200 to 1,400 to insanely high levels. So all I'm going to say is just be cautious, be smart, be aware of where we are fundamentally and technically. And on a risk-adjusted basis, there is better opportunities out there in the market that you can take advantage of as well. So hope you all enjoy this video, found it helpful. Make sure that you drop a like and don't forget to subscribe to the channel. And again, links to our Discord and Patreon is going to be down below. Again, feel free to ask any questions in our Discord. Join 16% annual discount. As always, happy investing. I'll see you all in the next video.